Immutable Opinion, I'm Asher Westropp-Evans, inviting you to prove me wrong. So, millennials are fools, right? I mean, that's the general media consensus anyway. They certainly have no idea about investing sensibly, what to do with their futures, how to bathe properly, what a proper retirement plan looks like, or anything besides hunting Pokemon on the go. I mean, look at what this bunch of useless sods are up to now. So we all remember the infamous bankruptcy cases from earlier in the pandemic, which saw market runs and hysterical bubble investments. You'll remember Hertz, Whiting Petroleum, Pier 1, and JCPenney, which all declared bankruptcy in the last few months, only to then turn around and see massive increases in share prices, with values surging by orders of magnitude. As millennial investors on Robinhood and similar trading apps pounced on the Chapter 11 filing companies, whose common stock, in all likelihood, will lose utterly all of its value. Hertz alone saw a nearly 900% increase in share price after filing for bankruptcy, and unsurprisingly crashed soon after, all going to prove that millennials are buffheads who will invest in even totally useless, valueless assets off the back of a little hype. These guys clearly can't be trusted, and really, it's pretty fun to poke holes in these lazy, foolish kids who are investing straight from their phones without the sort of sensible middlemen that have helped cool heads prevail for decades. What these punks need is a managed mutual fund, spearheaded by the sort of experts that can consistently outperform the market. That's what any right-minded investor needs. Except, they don't. Outperform the market, that is. In fact, according to research conducted by Ivo Welch, a finance professor at UCLA's Anderson Graduate School of Management, in his new paper entitled Retail Raw: Wisdom of the Robinhood Crowd and the COVID Crisis, 71.9% of domestic US equity funds underperformed their benchmarks. In fact, Welch's research finds that as a group, if you were to look at all Robinhood investors and put their investments into a single portfolio, which he calls the actual Robinhood portfolio, or ARH, they've actually outperformed the market. Welch says, and I quote, "In sum, the ARH portfolio performed surprisingly well. Collectively, the Robinhood crowd may have anticipated subsequent interest of other slower retail and other investors. It also suggests that the narrative that Robinhood investors were cannon fodder for more sophisticated day traders seems misplaced." Now, for the record, that's professor speak for shut your damn mouths, these folk got game. Welch's findings are an illustration that, while not every investor is rational, the collective wisdom of the crowd is often superior. So keep that in mind the next time you hear a Wall Street guru insist that small investors who frequent platforms such as Robinhood don't know what they're talking about. There's a distinct possibility that, as a group, those small investors are doing better than that quote-unquote guru. So how does that impact crypto investing? Well, much like the neobanks and app investing movement, cryptos are so far largely dominated by younger investors who are willing to adapt, understand the tech, and take those risks on a nascent asset class. And yet, in the United States, normally a leader in financial development, where there is such huge crypto potential, governments have pushed to crack down with stringent regulation around cryptocurrency over the past few years. And the most frustrating part? The very laws meant to protect citizens can make it extremely difficult for them to have trading careers in crypto, even costing them potential profits as tax-paying individuals trying to abide by the current rules and regulations in a respectable manner. The problem is this infantilization of younger investors, a meme pushed through media and social media trends alike, keeps regulators from taking these budding young capitalists seriously as their ideas and trends enter the market. Crypto markets are now worth over $350 billion. Still a long way to go, and certainly nothing like the gold markets, but nothing to sneeze at, to be sure. And certainly not something the US government should be trying to squeeze out. Discourse and narrative hold unreasonably large sway on lawmakers. So let's stop running around with unsubstantiated notions that millennials are flighty and emotional investors, that crypto markets are havens of crime syndicates the world over, and that only experts can properly predict markets. The sort of research as conducted by Welch is exactly what we need to root out the truth behind these senseless ideas. And we should put stock in data that truly helps us to understand the world around us. We don't need to question it through the anecdotes of our own existing lives. There is data out there. So let's use it and prove that millennials are not as incapable as everyone likes to think. And maybe there is a little wisdom out there in the crowd. But you know what? Prove me wrong. I'm Asher Westropp-Evans, and this is Immutable Opinion.